Hey traders and investors, it's Serge Berger here. Today I want to have a look at a couple of moving averages that have really helped me over the years to gain an edge over the near-term price direction of the various sectors and indices and single name stocks that I watch. For the sort of medium-term time frames, I tend to just use 50, 100, and 200-day moving averages. But when it comes to the more near-term, and that's a lot of times what we first need to look at before, having some sort of context for the medium-term moving averages. I've played with a lot of stuff over the years, but I saw more and more people starting to use the 8-day moving average and the 21-day moving average. The 8-day moving average here is in blue, the 21 in yellow. And I'm just going to go back to the example of the SPY, or we can just do the S&P 500 itself. And you saw that a lot of people really started freaking out, even just yesterday, Monday, July 7th, after one day of selling. But really, if you had looked at the near-term chart here, or the daily chart using these near-term moving averages, you would have seen that we hadn't at the close yesterday, we weren't even close to even the 8-day moving average. Today, as of right now, as of this recording right now, we are right at, or actually marginally breaking below the 8-day moving average. So that is really a first sort of flag, first area to raise a bit of a red flag. Before that, it's just mean reversion. So from here on, a next potential support area would be the 21-day moving average for the S&P 500, which would be about 1950 if this level breaks. So you can look at this through various in various parts, even just this year. Every time the S&P 500, and again this works in single name stocks and ETFs just as well. Every time it got too distant from the 8-day moving average, which is the blue one, and obviously hence also from the 21, it then fairly quickly rebounded, or at least trotted sideways, so we'd get back to it. That certainly happened at the February lows. It again happened here in the April lows. So that's the kind of stuff you can look at. It's really not until we see a real crossing of those two moving averages, like we saw. Let me go back to 2011, or just the last time we actually had some sort of a downturn here. Let me just zoom in here. So let's look at, for example, here in the late part of 2012. It was the autumn which led to the sell-off into mid November. You started to see a topping pattern both in terms of price as well as the 8-day moving average slowly getting below the 21-day moving average, and that ultimately resulted in stocks moving quite a bit lower. So 8 and 21-day moving averages, for me, an invaluable tool to measure near-term price sentiment. Hope this makes sense, guys. As always, if you've got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.